Good evening, ladies and gentlemen. My name is Shane Skwarek, and on behalf of the Market Technicians Association, I'd like to welcome you to another webcast as part of the MTA's educational web series. Today, November 10th, 2011, we are joined by Linda Raschke, CTA, as she presents Traditional and Unique Ways to Use Relative Strength. Linda Bradford Raschke is the president of LBR Group Incorporated, a CTA, and president of LBR Asset Management, a CPO. She began her professional trading career in 1981 as a market maker and equity options. Ms. Raschke was recognized in Jack Swagger's critically acclaimed book, The New Market Wizards, and is known for her own top-selling book, Street Smarts, High Probability Short-Term Trading Strategies. She has been featured in dozens of financial publications, radio, and financial television programs, has served on the board of directors for the Market Technicians Association, and was president of the American Association of Professional Technical Analysts. As always, we do welcome your questions throughout the presentation. However, in the interest of time, we will not be able to get to them until the very end. As a reminder, your participation in today's webcast does qualify you for one MTA continuing education credit, which will be automatically added to your account if you registered online through the MTA website. And as without any further ado, I'd like to present you Linda Raschke.
Hey gang, thank you for having me on today. I'm always happy to talk about some subjects that are near and dear to my heart, and those are always pertaining to the field of classic technical analysis. So I thought for today's session we would review what I think is one of the more neglected areas among certain people of technical analysis, and that is relative strength. So we're just going to simply quickly summarize the history, because it's always important to see how the fathers laid the foundation for it, the forefathers of technical analysis, discuss a bit of theory, and then I'm going to show you both traditional practice of relative strength as well as some of the unique ways that I use it. It's one of those indicators that's not a true primary indicator. You never want to use relative strength as your main decision-making process, but if you understand the power that it can add to your analysis in terms of increasing your overall beta, in other words, if you're going to make a decision to buy, the vehicle that you choose to buy could lead to at least twice the gains if it's well bought versus trying to buy a dog in a wrong type of environment. And lastly, since nothing works 100% of the time, including relative strength, it can actually be a double-edged sword and bite you in the rear if you try and use it in the wrong type of environment. We'll discuss some filters. So let's just advance to the next slide here. Some filters that you should be aware of if you are applying relative strength to your work. I guess these slides are made available for people to review afterwards as well. And if not, I'm going to leave you guys my email address at the end of this too, and I'm happy to make the slides available for you to download on your own as well. So if I go through some of them fairly quickly, forgive me, but I'm going to assume that you'll be able to go back and review them then. So just in general, the theory behind the relative strength is that the strongest groups are going to get stronger, and that, of course, works well in particular types of market environments. The bit of the history behind this here, Robert Ree, as you well know, wrote about the writings of Charles Dow, and he used to take Dow's writings and summarize them in a series of articles of Barron's, and compiled a lot of his work that Dow actually never was intending to write an initial treatise on technical analysis. So he was one of the first to compare the percentage swings on an individual stock to the percentage moves on the Dow Jones. So you're comparing the stock to an index. And then to expand upon that, Gartley then looked at groups instead of just individual stocks. And he was actually one of the first to quantify relative strength work. So all of this you can follow along in the slides. I just feel it's important to show the foundation that there's a trail here of classic practitioners of technical analysis going back 100 years, you know, before we had computer models to do all this analysis for us. Then, of course, Richard Wyckoff, everybody's familiar with his name, and here we're starting to introduce a little bit more of the pattern recognition tools that we'll review on some slides later on. So he would sit there and watch which shares reacted down the most versus the least. So if we're in an uptrend, he would want to be buying the stocks that pulled back the least amount. And so we'll look at this in some pattern recognition. You know, if we start laying this into a nice structural framework, it's very easy to latch on to an idea when we can put it into a way to practice it, you know, such as a quantifying method. Because relative strength, keep in mind, is very counterintuitive for our American culture. In other words, if I told you that you're going to go pay up for the strongest thing up there, that's something that's not, we're not naturally ingrained to do. You know, we're all programmed to buy stuff when it's on sale, you know, and buy stuff at a discount. And therefore, we often confuse buying stuff that's the weakest and the cheapest. And sometimes it can stay weak and cheap for a reason. So not everybody feels comfortable buying something that's really not even pulling back, you know, that much to give you a chance to buy it. So as long as we keep on educating ourselves into the theory behind this and the math behind this and the statistics behind it, then it makes it easier to be a believer in it. And so with Wyckoff, when we start seeing these swings and stuff, I know you're all going to be quite adept and proficient at doing this just from a visual perspective as well. Now, I know I'm going to skip over many people that contributed to relative strength, but in my book, these are the people that made the biggest impact on me, either by hearing stories about them or reading some of their works. George Chestnut was first talked about to me by one of our near and dear friends who passed away a couple years ago, Mike Epstein. And Mike Epstein actually had been on the trading floor since the 1950s and had actually executed orders for George Chestnut. Now, George Chestnut had a stock fund called the American Investors Fund, and it actually outperformed the Dow for 30 years, and I'm not sure if that is a record that has been beaten to this day, outperforming an index for 30 years. And this is when technology was primitive, relatively primitive, and I think he had an office up in White Plains, New York. And just to hear Mike tell stories about this man, he was, used to smoke 3 packs of cigarettes a day and closed himself in this office with just a secretary. So I don't think anybody else could have come close to doing his work because they probably couldn't get near that office without suffocating. And he used to sit there and go through at the end of the day, and if you remember those old IBM punch cards, this is how he computed relative strength. And he would walk across the street, the railroad tracks, to the office, or walk across, there were some railroad tracks he'd walk across to the office and run these punch cards every day. And so that's how he first came up with his relative strength rankings in an era where there wasn't PCs accessible to everybody. So the proof of the pudding that this stuff really works was in the performance of some of these long-time market professionals. Now, Edward Coppock, everybody's familiar with the Coppock curve, but he actually did a lot of studies on relative strength and published his works in Barron's, and he actually started looking at it on an intermediate to longer-term horizon. Robert Levy really did some hardcore academic studies on this, and he was the one that first concluded, as far as I know, that this traditional 6-month window by which we measure the relative strength was optimal. And if you use a 6-month window, then that predicts out for the next 6 months. And you could also use a 12-month window. Now, the reason why this is important to start looking at some of these methods used to compute relative strength, because as you well know, if I took a portfolio of 100 markets and I looked at the relative strength going back 3 days versus the group of relative strength rankings listing back 20 days, of course, the list is going to change markedly depending on where you start your look-back date. So this can become a very important issue when we start to get into the details as to how and when to apply our relative strength rankings. So we don't want to have a random process by which we do this. We want to do it in a methodical manner so that we can get consistent results. So as an aside, the worst look-back period that you can use is a 4-week period. That turns out to be the worst period for walk-forward results. So at any rate, I think 6 months is still a very traditionally accepted look-back period by which to forecast what's going to perform best into that next 6 to 12-month horizon. And in fact, this was picked up upon and expanded on by William O'Neill. Now lastly, the last person I'm going to mention is James O'Shaughnessy, and he wrote a book, What Works on Wall Street, and it was the first book, in my opinion, that truly brought this relative strength, the power of the relative strength, to the forefront with the quants. And of course, the quant community exploded as of about 15 years ago. Now, in that book, if you haven't read it, I would highly recommend it because he summarizes about 14 different approaches to timing methods and selection methods and stuff that you might stand a chance at outperforming the indices with. And what he mentioned was the problem with relative strength is that even though it can expand your returns to the upside, it also will increase your standard deviation in the down moves, which is something we don't want. So it definitely increases your beta, and that can be a double-edged sword in that it's going to work against you as well if you are not careful about the type of environment that you are applying this to. So with that said, just a quick summary there of the succession of relative strength work. When do we want to use relative strength, and when should it not be used? And obviously, it's going to work best in an uptrending market, in heavier volume markets, and even when I show you some really cool short-term tricks with it, you want to be careful and you want to do that in a volume in a volume market. You know, we don't want to apply relative strength to low volume environments, be it on a day-to-day basis or even a longer window. And part of the reason is because volume represents the higher time frame player. In other words, when there's good volume in the market, we have the institutions, we have, you know, the professionals, we have large entities moving huge amounts of money, and so that leads to continuation. And unfortunately, when you don't have the volume, it's a light volume environment, you're much prone to a testing type of price behavior where you're not going to get the follow-through. And so therefore, if you try applying relative strength in a lighter volume trading range, it's very easy to get chopped to little pieces and whipsawed because you'll be buying high and there's just no follow-through, and obviously you know, it's a game of hit your head against a cinder block wall. So we want to stay in rising markets, bull markets, heavier volume environments, and in particular thrusts off a major cyclical low. It works extremely well. I'll show you a great trick for catching something just 2 or 3 days off a low that's going to continue to outperform. So be aware of those environments. Now, obviously, in a downtrend, you can get creamed using relative strength, and part of the reason is because the longs are already loaded up with the leaders. Everybody's been following a relative strength approach in an uptrending market. So when it comes time to liquidate, those are sometimes the stocks that can have the biggest breaks. And I'm sure you've all heard the expression that, you know, in down markets, they tend to throw the baby out with the bathwater. So it's like anything goes, and especially the most liquid stocks, because that's easiest to hit. And if you've got redemptions, you don't have much time to thoughtfully do you know, selections in your portfolios, which you choose to keep or which you don't. Sometimes you just end up banging bids. So with that said, we want to stay away from relative strength concepts in a downtrending market, and we want to stay away from relative strength markets just after a downtrending market, because that's when we start to get the heavy rotation and the heavy consolidation, and it's going to take a little bit before you truly establish a base which you can start to then play your relative strength game back to the upside. So again, it's going to be something that can work against you in a downtrending market. But with that said, you want to use the same approach with our pattern recognition that we'll look at. If you're looking for stuff to short, you really do want to keep on shorting the stuff that is the weakest and has the smallest reactions back up to the upside. So just to summarize the applications that we're going to look at here over the next 30 minutes, basic traditional model with a 6-month look-back period, okay, and don't go down to too short of a time frame. We're going to also look at little tricks to get the early birds off those cycle lows. We're also going to look at trading in stocks and futures on a short time frame, in particular, even just day trading. And this is something that I specialize in. How do I do this with the futures, and how do I do this with stocks? Because I use the same approach with both markets, even though, as you all well know, the futures markets are 24-hour markets. So we're going to get upon a little issue there with how do you tell these opens in the futures, and we don't want to end up comparing apples to oranges. So we'll look at some neat tricks there. And then lastly, of course, everybody knows the practical applications of using confirmation and non-confirmation with relative strength. So let's get into the meat of the matter. And we're just going to start off by looking at 4 indices. I actually threw the DAX in there because during the last couple of months, obviously Europe was the main driver in terms of the market psychology. And now this is more of a Wyckoff approach here. You can see I've got the Russell and the NASDAQ and the Dow. Okay. I had a little, by the way, we will have plenty of time at the end of this session for questions. If you do want to type them in now, that's fine. I'm not going to stop to answer them, though, until I've run through my presentation. So let's just look at the first reaction up that we had after we made these new momentum lows at the beginning of August. And you can see every index there basically did an ABC type of correction up. And then where I've got that first little mark there. And the DAX obviously was the lone duck there in that it made a lower high. And then you can see, because it was the weakest on the rally up, making a lower high, that was the one that then gave you the best results on the downside there, selling that reaction up. And so this is a basic game that we still play all day long and week after week with the Russell, which represents the small caps, the S&Ps, the Dow, and even though I know that the NASDAQ is totally distorted by Apple still, you know, we still use that as well. So, you know, we use it in our practical trading as well as for our analysis. So in this case, we had a non-confirmation in that the fact that the DAX made a lower high while the U.S. indices made a higher high, and that led to a better bonking down where the DAX actually made new lows. And then if you notice, I'm sure everybody's seen this for themselves on that last October low, the Russell and the S&Ps, of course, made a lower low, and at this point, the NASDAQ made a higher low, and so did the DAX for that matter. And so you had a pretty major non-confirmation again, and all the stocks that didn't make lower lows actually gave you the best performance to the upside, and this is easily reflected here in that NASDAQ. You had some beautiful moves in the semiconductors and technology in general, as well as the assorted whatever. And of course, this is easy to see in hindsight, but we're going to, again, prepare ourselves to be right on top of these things as they happen. And that's the best thing about monitoring this one swing at a time. We don't have to forecast too far out in the future. We're just simply going to be forecasting, and by the end of this presentation, you'll become experts in this yourself. We're just going to be immediately forecasting our next swing and where do we get our most bang for the buck there. So this is a pretty basic pattern recognition approach to the indices. And here I just took 2 ETFs, and because you know, it's become quite popular in, I'd say, the last 8 years to do relative strength timing with the ETFs. And most people do quantify it and try and stay with the strongest three and throw out the weakest three and so forth and so forth. But again, I just wanted to show you the process, how relative strength changes as the swings unfold. And obviously back in 2007 in that go-go push up to the top, the Brazil was one of the leaders, the relative strength leaders to the upside. And here I've got Mexico just underneath it. So I took them both from our hemisphere over here. And you can see that on that rally, you started to hit a point where the Brazil was making higher highs and Mexico lower highs and so forth. And on the pullbacks, you know, it's obviously to see that Brazil was still the strongest until you had that final push up into that third peak up on the top, okay? Now, this is a weekly chart, by the way, too. And just as an aside, you can apply these concepts to 5-minute charts, daily charts, weekly charts. It really doesn't matter. You just really should stay a notch above the noise in your time series data, because once you get into the noise, most of the technical analysis standard tools we know of, be it momentum oscillators or relative strength or something, once you go down to the noise, our tools will become relatively worthless if you go down to too short of a time frame on this stuff. So at any rate, you can see on the ensuing sell-off, if we just compare back to previous lows, you can see at the left-hand side of the chart that 2006 visible swing low, and the Brazil ETF there stopped right around that area, and of course Mexico dove a little bit deeper, and on that bottom you had Brazil making higher low and Mexico making a lower low. So let's look then on the reactions back up where we started to see this first shift in the relative strength, and you can see it was obvious when Mexico started making a higher high and Brazil was making a lower high, kind of reflecting the fact that it was running out of gas and we were getting a little bit of a change in leadership there. And of course then on this last rally that we had into the start of 2011, Mexico was the relative strength leader. So this is why it's important when we do our relative strength work to understand that over periods we do get this shifting and this rotation even in the relative strength. And just because you did some type of research and the Swiss franc was the relative strength leader 3 months ago, that can easily change, and we constantly need to be updating our work depending on the time horizon that you are looking out on. And again, you can see that relative strength relationship still held up as Mexico pulled back and made a higher low, and Brazil made a lower low. So when you do the visual pattern inspection, it's always comparing the swings as well as the previous highs and lows. So basically resistance and support and momentum. Okay, let's just go back and we're going to look at some stocks when we came off that last low that we looked at. And this is just to reiterate what I was talking about with the NASDAQ. And, you know, I know that everybody knows this. I know you guys all know this intuitively, absolutely. But sometimes we just need a reminder as to how powerful this stuff is as well. And, you know, what they say, a picture's worth 1,000 words, right? So on the lower left, we've got the E-minis, or the S&Ps if you want. And you can see on that push down into the October low, I picked a dog out there, 3M, which actually I think was doing okay today. So, but 3M was the weakest one, and you can compare that lows to Intel and Amazon, which greatly went on to outperform to the upside. And I just have to share with you everything I've learned, I have learned the hard way. And I'm probably the guiltiest offender of violating this rule in my early trading career when I was on the trading floor and I was doing equity options, and we had this whole universe of stocks to trade. And you know, when you're a market maker, we have a very short time horizon. I wish I knew now what I knew then. I mean, vice versa. I wish I knew then what I knew now. But suffice to say, you know, we're just trading on our very short time frame. and we'd have these big bull markets unfold, and these rallies would progress, and you sort of feel like you're left in the dust because you bought something and you sold it an eighth higher or a quarter higher, and 3 months down the road, the darn thing's up 20 points higher. So that's sort of the story of my livelihood there in my early trading career. So what's the natural thing that you want to do? Well, let me buy something that hasn't moved yet, by George, and I'm going to put that in my portfolio and sit on it, And then you find out 3 years later you're still sitting on the darn thing and it's gone up 5% where everything else has gone up 50%. So that was a story of my first 10 years of trading, and I know that we've all been there, done that at some point in our careers. So, here's just to drive home, you can buy the dogs and they're going to stay the dogs while the good stuff is obviously in demand. It's all supply and demand relationship. So the strong stocks are strong for a reason because they're outperforming in their fundamentals or their earnings or whatever the case may be. We don't care about the fundamentals and technical analysis, do we? No, we just care that enough people want to buy it that they're willing to pay any price, and that's all that matters for that particular swing. So let's go and look now at a little bit more traditional way that we can quantify this. And the beautiful thing about applying relative strength to our work is it's such a luxury to have all the technical tools and computing power that we have nowadays. I mean, TradeStation is a beautiful program for radar scan, and there's numerous free scanning functions on the internet, and so many different firms have incorporated it into their software to make it easy for the user to put in their portfolio and run different scans with relative strength look-back horizons. So it's a real luxury, that we have such easy tools to use nowadays. And so this is just simply a CQG chart here showing what happens when we divide the stock into an index. And this is something, again, if we go back and we look at that history of technical analysis was done 80 years ago, comparing the stock to the index. And so what I did here is on the top chart here, on this top graph, we've got the actual underlying instrument, in this case Coca-Cola. I took two stocks from the same industry group, so I wouldn't be cheating here. And I simply ran a 180 period moving average just for a general way of adding some structure. There's no right or wrong moving average to use on your charts. If you want 100 period or 120, it doesn't really matter. It's just helping you put the price relative to some mean value. And so in this case, it's pretty much stayed above its moving average the whole time. And then on the bottom chart, I simply put in the line chart of Coke divided by the S&P cash there. You can see these are daily charts, by the way. I know it says delayed 15 minutes up there at the top. And so what we see is that the majority of the time, just running 180 period moving average of this, just to give us some structure, Coca-Cola was outperforming the S&Ps, or doing a little bit better. It had a steady uptrend to it from a relative strength basis. And what we'll see is when we look at some more charts, obviously you can apply all the same types of technical tools that we would to an underlying market to the actual relative strength work. So we can have relative strength improving, increasing in momentum. We can have relative strength holding trend lines, or we can see divergences in relative strength, which may not be an outright sell signal, but it can start to give us a warning that there's rotation going on and other groups are gaining in leadership, if you will. So this is just a basic visual here of a stock that's had a steady uptrend. It's been trading above its 180 period, and it's been showing superlative relative strength. Now, check it out. Look at the right-hand side of this chart, and you'll notice that the relative strength shot up dramatically, but yet the price really wasn't doing a whole lot up there. And, of course, that was because that big sell-off that we had, the actual S&P was very weak during that period. So the mere fact that Coca-Cola was holding its own is what caused it to shoot up in those relative strength readings. So let's just compare this now to another stock in the same industry group, Pepsi-Cola, and you can easily see that it's definitely painted a different picture. It hasn't held so consistently above its 180 period moving average. And check out there back in October of 2010 when this dropped dramatically below its 180 moving average, and that's its relative strength on the bottom divided out by that cash index. So, it was warning you that, there was, even though it had that little blip up there in January, it wasn't really able to show much trend in its relative strength rankings. And, it would have been a waste of your time to be too fully invested in a particular market like this if you're looking out at where is it going to be 6 months to 12 months time horizon. So you would have done much better to pay up while this was still going strong, even though it feels like you're paying up, than to sit there and say, well, Coke outperformed, let me try and, grab Pepsi. Maybe it'll be dragged up by Coca-Cola, and it just doesn't work that way. So let's just look at a couple more now. This is just to summarize here ways that we can apply technical analysis to relative strength. And I know that all you guys know all this stuff because you're very proficient in this, but it's just good to review it. So, is the price rising and is the relative strength rising? That's when you're in the cream of the momentum curve and the most bullish scenario that you could have. And of course, it's not going to stay that way for an extended period, but we just want to ride that wave as you've got the price rising and the relative strength rising. And then perhaps if you start to see some divergences, you might want to lighten up. I would never short it, if you see the divergences, but perhaps then that would be time to take some off the table. And conversely, when price is falling and the relative strength is falling, you saw there in that early example that the DAX was the one that was making the lower lows and the lower highs until it had its sell climax. But at some point, it's going to hit a period of rotation, and you'll start to see the divergences, and another index might be coming weaker. So again, while it's going through that price falling and that relative strength falling, that's the sweet spot to the downside. So just to look again at 2 more examples, and I'm going to show you where, when I put these slides together, what the relative strength, how it was changing, its leadership just a couple weeks ago. So here we've got McDonald's, and you can see that even though it dropped in its relative strength rankings in the middle of the chart here at the bottom, it still was holding its 180 period moving average, and it still held a good uptrend overall in general. There's still a channel that you can draw on that stock that it was violated. So I wanted to show you a case where we had the divergence in the relative strength. And you can see that right at November 2010, right at that first high there. And you can see how that relative strength made a lower high while the price made a higher high. So we had a divergence there, and that, like I said, might be a case to lighten up. It's not a reason to short the stock, but that's a period there in the middle of the chart where you started to see rotation into some other groups. Now, even though it dropped below the relative strength rankings overall, in that it dropped below its moving average there on the bottom graph, you can see that the stock itself wasn't in trouble. It just was going through a rotation period. So, and then once again, when you see both of them turn up through their 180 period moving average, for me, that's a pretty strong buy signal if you wanted to be very aggressive and catch that sweet spot of that, the part of the momentum move. So McDonald's is another one that held up extremely well as the overall indices were getting a little bit brutalized with that fear with the Europe implosion. Okay, now let's just compare this to a case where we had a stock drop below its moving average in the underlying chart, as well as the relative strength. And you can see that with Deere clearly, it dropped below its moving average, which in and of itself is not necessarily a sell signal, but when you start to look at the relative strength and see how that slipped as well, that would be one I would just want to get out of my portfolio for a little spell there altogether, because now I see risk. There's risk. It's underperforming, and you're in a downtrend. All right, so now let's just take a look. This was right after we were coming off that October lows, and I wanted to show you, this was right at the time what I got in my work, that we were starting to see oil shares outperform. So this is a case where we were poking up through that moving average, and the relative strength was starting to shoot up through the roof there. And this is Chevron, and at that time we were right around 101, and we shot up to 110 there. And obviously crude has been way outperforming everything to the upside, because I follow the copper and the currencies and gold and all these other markets, and crude's definitely been the relative strength leader. So this is what it looks like, or even just a couple days before, when you see it start to shoot up in relative strength, and you see it start to poke back above its moving average. Now here's just one thing I want to say to you. If you are newer to the field of technical analysis, and newer, that means any time in the last 3 to 4 years, 3 to 5 years, because there is such a learning curve, okay? The real learning is going to come in not from listening to my slides, not from reading textbooks, not from reading other people's work, but the learning comes in when you start to apply this on a daily basis or a weekly basis for yourself, okay? And you start to feel what it feels like right as this stuff is turning up. So that's, again, the extreme importance of arriving at a consistent methodology that you can apply on a regular basis, so you gain confidence, not just by saying, oh, when it goes above the moving average, you're supposed to buy, or when the relative strength line turns up or something, but so you can see how that all unfolds. So here's an example for you of something that was unfolding at the time, and then you can see where it is right now. All right, and that's my 2 cents worth of lecture. Now, that's your long-term 6-month period, or doing some work dividing with indices and moving averages. Let's just go and look at pops off these cycle lows here, because that's where I've really had some great success. I put in the middle of this chart here that last low in the S&Ps, and this was actually back in mid-July, or rather last summer, 2010. I didn't want to use chart examples from just this summer, because everybody's seen that one. But this is when we were coming off of that consolidation in 2010. And you can see the S&Ps popped up there right as the Fed started hinting about quantitative easing and so forth. And what I like to do is I like to go back and take a cycle low, and usually what I'll do is I'll take a 3-period RSI, or sometimes I run an RSI of the momentum, because that gives me a way to quantify it. So let me just repeat that. I'll use a 3-period momentum, in other words, comparing today's close to the close 3 days ago, and I'll usually do this 3 days after a cycle low, because I can never see a cycle low as it's happening, right? Okay, all right, but I can always tell it after the fact. So I figure after 3 days, you can pretty much tell if it was a cycle low, because we get those breadth thrusts starting to come off of that. So I'll take a 3-period momentum, and I'll just simply run an RSI on that to normalize it. And then that way, I can rank it. So now I've got my portfolio of all the things that I like to trade. I try to stick with the liquid big cap stuff in general. And I'll do my ranking, my relative strength readings off of the momentum there. And that's going to tell me which ones are going to continue to outperform. So this is a case here where Amazon on the left, I didn't get a chance to go back and run the RSI on the 2 or 3 period momentum. Momentum's the same as ROC, which is rate of change, momentum, same thing. But you can see here how that first thrust up off of Amazon just really caused that rate of change to shoot up and take out those previous highs. I like that with oscillators. I like to see oscillators take out other highs in previous peaks in the oscillators, and compare that to eBay, which didn't give nearly the same thrust. So those are identical dates off of that September low. So you see, Amazon was definitely the superior one. And what did you have to do to get on board there? You had to pay up. You had to pay up. So that's why I need that extra quantitative work and statistics so that I feel confident that I'm not paying up something and I'm going to get whacked, when it comes back down. And of course, your best indicator for confirmation is going to be volume, because if there's volume on that breakout, it's got a less likelihood of being a false spike up. So just compare the two and see which outperformed over the ensuing 1 month, 2 months, 5 month periods. And clearly it was the one that had that burst of demand off of that cycle low. All right. So another thing that you can do, and I'm just giving you different ideas here with the short-term tools that we can use to quantify stuff. I just simply took Alcoa because it was one of the dogs, aluminum here, and you can see when we came off that first swing low just most recently in October, I just compared the relative strength reading just 3 days after that low. This is just a simple 3-period RSI. And you can see that it was fairly mediocre there, around 30, I believe. And let's just compare that to the position of a different stock here, which actually was quite high, Walmart. Now, you wouldn't normally think about going and grabbing some Walmart coming off of a swing low, but this was 3 days after that cycle low there, and this was one of the ones that popped up on my scan as actually being fairly high. So you think, wow, that's kind of like an overbought reading, isn't it? No, I think that everybody's become very smart and savvy in their technical analysis these days to know better than to say just because an oscillator is high, it's overbought. In fact, I've never seen so much awareness. Everybody's very educated now into the power of concepts like breadth thrust and oscillator thrust and so forth and so forth. So I know that all you guys are smarter than just to think because the RSI is high, that's overbought. It can also be a sign of strength. Okay, now back to our market environment that we are in, because if we are in a light volume trading range, in those cases, it is more likely that an overbought oscillator or something that's reading high is going to lead to a reaction down. But we had very heavy volume in this period, so I put a little bit more faith in the fact that that was going to lead to good follow-through. Everybody's with me so far, right? Trust me, I will have plenty of time for questions. We're just going to speed this up a little bit now to show you my favorite tools here for day trading stocks and also futures. And I always like to do a little bit of day trading or scalping. It's kind of like a little bit of supplemental income for us in our approach to whatever. Now, we just got through looking at measuring relative strength off strong lows or swing highs, the swing highs, swing lows, the cycle lows, and so forth. What do we do, though, when we are going to day trade? It's not nearly as important to be having cycle lows. So instead, what we're going to use is the opening price. And all of you who are familiar with market profile concepts know the power of open drive. Okay, so just like we're looking for the initial demand off a cycle low, here we're looking for the demand or the selling off of the opening price. And if we see something that's super strong off the opening price, those are the things where we're expecting continuation. So I'm not a huge fan of day trading stocks, but this is the one day trade that I will make for stocks. It's just one trade a day. It's in a good volume in market, and I'm just simply going to go with the stocks that did the best off their opening price. Usually about 2 to 3 hours after that, they'll have a little 15-minute consolidation. You can even use the S&Ps to time it, buying a 15-minute pullback, and then I'm going to simply buy the stocks that were the strongest in that first 30-minute bar. Don't do this on light volume trading days because you will not get the expected follow through. So let's look at what this looks like. I picked 4 stocks. This was all on the same day. And in fact, this day was actually a heavy down day. It was a day of extreme selling. But you can see I've got a little line pointing to the first 30-minute bar, and of course on a heavy selling day, so that's basically like a utility. So that was a safe thing to jump into. Costco is fairly safe as well. But you can see we had huge bar down in both Joy and in RIM here. And those are the ones that gave you that little, remember that little 15-minute bear flag there in the middle of the day? It just looks like a little up bar on the 30-minute chart there about 2 hours into the day. Bam, that's your short trade, and cover it in the afternoon. So that's my simple little day trade. And even though this was a really heavy down day, you still had a pullback on the relative strength leaders off the opening price, and they held, you see? So in an up market, I only would do this to the long side in a general positive bias market. I'm not going to look to buy these pullbacks on the right-hand side in a market of extreme breadth to the downside. But I just wanted to show you how well this works. So I use TradeStation to do my scans for the first 30-minute bars, what's trading up best off of its opening price, and what really didn't trade below its lows. Very important. Now, this is what I use to quantify my volume for this. I use the NYSE volume, and I look at 30-minute bars, and trust me, even though we only have a small percentage of volume done on the New York Stock Exchange, it still works as well as anything, and it's easy for me to see. So you can see on this last day here, that first 30-minute bar was much better than the previous 30-minute bar of volume. So that's okay for me to play this game on a day like that. If I go back to the day before that, and you can see the succession of 30-minute intervals of the volume readings, you can see that the first 30-minute volume was much lighter than the previous days. So that is going to be a choppy consolidation day. And what I've found is that if you see extreme volume or heavy volume in the first 30 minutes, 90% of the time it's going to stay that way throughout the day. And a day that starts out really kind of crummy and doo-dah, chop, consolidation, pretty much stays that way for the rest of the day. So that is what I use for my volume filter. Now, let's get down to my real heart and joy here. I talked about the futures markets, and I talked about the problems that we have in that you can have 24-hour sessions, you can have chopped up sessions like the grains, you can have, all different types of session starts. But when we did our modeling for time of day functions, in other words, looking at what time were the highs and lows made for a 24-hour period, we found that if you just try and run it over a 24-hour time frame, it's just a mishmash. It's going to be random. There's not one particular time of day that stands out. However, if we divide our day into 4 parts, which basically represent the opening or the closing of the major trading zones. So, of course, in the evening, we've got Asia, and then 1 o'clock or 2 o'clock in the morning, depending on what time zone you're in. Now, you've got Eurex opening and Europe opening, and then I use a 7 a.m. Central Standard Time start date for the U.S. session, even though, of course, the stocks don't open up at that time, a little bit later. But it tests out that 7 a.m. is significant. I figure that's 8 a.m. for all you New Yorkers there. That's when you actually sit down in front of your screens, and then the bonds start going full tilt boogie. And you would be amazed if you're trading gold or crude or currencies or even the E-minis, how many times the highs or lows for that morning session occur right in that first 15-minute time frame. So here is again, this is just one day. I'm using 30-minute charts, and I've got the bar, my little trend line noted on the charts pointing to the 7 a.m. time, okay? So you can see, obviously, sugar on the left-hand side was a drive down off of that time. On the right-hand side, I've got the Swiss franc up at the top there, and that was a drive up off of the 7 a.m. opening, and so forth and so forth. So on the left side, I put up 3 markets that I would be more inclined to be trading from the short side. And of course, you don't know this in the first 30 minutes, but you know, if you give it an hour or so for the day to unfold, and you can see once again how you just get that midday inflection point. So if you're willing to give up being on board or not on board in that first 30 minutes, let the market tip its hand, wait for the reaction, and then you get the little second part repeat. Maybe it's just breadcrumbs, all right? It's not going to be a home run. It might just be breadcrumbs, but you have a much higher percentage win in your favor. So that's the trade-off. If you're more aggressive and you get right in on the opening, there's not necessarily the confirmation that you're going to be right or wrong. You'll have bigger wins, okay, but probably a smaller percentage win-loss ratio overall. So now that you guys are all very proficient, okay, in this stuff, this is what my screen actually looks like, where I can plot the 7 a.m. reading on my little 5-minute bars. And I actually can fit, I actually have 20 different markets that'll fit on one monitor. You can do this with stocks too, whatever, you know, whatever your portfolio is of stuff that you're monitoring or trading. And so it's very easy to see, is stuff holding at 7 a.m.? Are we rotating around it? Because some days are just consolidation days. For example, the bonds you can see in the upper left corner just rotated around that 7 a.m. reading. So the markets will alternate. Some days they'll trend and have a strong trend. Some days they'll rotate around it. And it kind of depends, believe it or not, on the previous session stuff. By the way, I'm going to be in Las Vegas next week. So if any of you are there, please stop by, and I'll be happy to spend more time with you showing you exactly how I apply this stuff. But just suffice to say, the weakest stuff will tend to stay the weakest. Obviously, sugar on this day was to the downside there. That's on the far left. SBEH is the marked sugar contract on CQG. And on the upper right grid, you can see one of the strongest ones, the Swiss franc. So I hope I'm driving my point home. Now, to test you all on this stuff, since you should have a PhD in this stuff after my babbling by now, I'm going to ask you to place your bets. Step right up and place your bets, folks. We've got copper on the upper left corner, Canadian dollar on the upper right corner, S&P and the Australian dollar, and then crude oil and the EC. And my question to you is, place your bets. Which markets are going to be the weakest on the close and which are going to not have as big of a push down? All right, so if I had to put a gun to your head and say, which are you going to short right here and get the most money? You know, place your bets right here, and then we're going to push the screen and see what actually happened. Okay, and what actually happened was, yes, the copper closed on its lows. The Canadian dollar closed on its lows on that right-hand side. And you can see on the bottom there, the EC really didn't go anywhere. Neither did the crude. So back again, let me just throw these charts up here. On that upper right-hand one, the Canadian dollar, how great would you have felt about shorting right at that point? And then that's what it actually did. So if I shorted right there, it looks like I'm selling at about 97.80, 97.85, somewhere around there on the right-hand side. And you can see the EC there on the bottom. And then I go here, and all of a sudden, I got 25 points under my belt on that, 25 pips, whatever you want to call it, on the Canadian there, and the Aussie closed on its lows, and the EC did not, and the crude did not. So you got to apply this on a regular basis before you become a believer and it becomes automatic to you. So let's try this game on the upside now. I got the same markets. No, I actually switched it up on you guys. I got silver there, silver and gold on the left, and the Aussie and the EC and the Canada and the copper, right? Pick your poison. Okay, so here, which are going to have the best reactions to the upside and which are going to have the poorest reactions to the upside. And, you know, we've got such global markets nowadays. It's just amazing the money flows. And I know that everybody knows the correlations are through the roof, and they're probably going to stay that way right now. In that, you know, every 99% of these things seem to move together, right? So I actually have my little grid up, and you know, I'm just looking at the cycle lows, and you can see these things with these swings up and swings down. So here you've got a low, a little cycle low. I've got non-confirmation, if you will, in that the gold on the left made a lower low, and the silver made a higher low right above it, and the EC made a lower low, and yet the Aussie and the Canada made a higher low. And so which do we want to buy? We want to buy the strongest. We want to buy the stuff that didn't make the lower lows, right? Okay, and so if we advance that, of course, look at the pop-up. Of course, this is just a little 5-minute time frame, guys. You know, I don't want to, like, beat a dead horse on this stuff. But the Canada, that by far closed the best. And look at the gold in the lower left grid. It closed the worst. I mean, it didn't really get going nearly the same the way the other ones did. So that's back to your pattern recognition with the swings. And I hope that I have been able to show you guys just one last little home run thing here. See, this is the deal. When you take a method and you apply it consistently, you'll see there are times where it doesn't really lead to much, but you're always trying to position yourself in your analysis and your trading to capture that one home run. And it's just an odds game. If we apply ourselves to the correct theory, then maybe 1 out of 10 times we'll catch that home run. And this was obviously during a period here where you know, the world's coming to an end and everybody's dogpiling into safe haven stuff, which was basically the yen and the Swiss franc, all through the beginning of 2011 when we had Japan blow up and then Egypt news. And I mean, the news just has been getting worse and worse this year, and the market's still climbing this wall of worry, isn't it, you know? But here's a case where you did get a home run on the relative strength stuff. With all the markets out there, the Swiss was long outperforming everything before it started going parabolic. So I just wanted to show you this is a case where it continually was making higher lows and higher highs while every market was either under a little bit of pressure or selling liquidation. And you can see even the yen, it was outperforming the yen. And of course, that ended up being to a home run trade. So in your trading career or in your technical analysis, we're always positioning ourselves for that. And maybe once in a blue moon, you will catch an outlier like that. So in the meantime, I've got plenty of time for questions. I hope I have showed you the power of using this not only for technical timing in the use of non-confirmation and confirmation, such as I use even on just the short-term intraday 5-minute swings, or on more major bottoms looking for the confirmation or non-confirmation on the lows, but also in terms of the length of the swings, the pattern recognition in the swings. We always want to be going with where is the supply-demand imbalance, because we hope to ride the coattails of that higher time frame player, because they're the ones that have the real dollars to move the markets. We need somebody that's bigger than us to move the markets in the direction where we're trying to ride their coattails, if you will. And that's on the pure supply demand. And then, of course, you can see all kinds of little tricks that we can use to scan, because nobody has time to go through a database of 1,000 stocks or even 200 stocks every night scrolling, looking for patterns in the swings. That would be absolutely ridiculous. So with our lovely tools at our disposal, we can do all kinds of ranking things. And the most important thing when you're quantifying rankings in any type of consistent fashion is, what is the look-back period that you are starting from? I myself prefer to sit there and use it based off a cycle low or a swing low. I do know a lot of practitioners who will pick a random thing such as the middle of the first month of each quarter, or, you know, it would be too obvious to do something like at the end of each quarter. You probably get a little bit of distortion there with stuff moving around. But these are just some ideas that you can play around with, and I hope that you find ways to incorporate them into your approaches to technical analysis. And remember, it's never a standalone technique by itself. It is always there for you to use as a supplemental tool. So with that, I do have plenty of time for questions. And let's see here. I guess, can everybody hear me okay?
Yeah, Linda, there'll actually be in that little presenter tab on the viewer questions window.
Okay. Can patterns and relative strength also provide buy and sell signals, similar to the way they can with oscillators? And I hope that that question has been answered, because the patterns would show up in confirmation or non-confirmation. Now, keep in mind that just because you have non-confirmation, that may not necessarily be a buy signal in and of itself. If it's at a bottom, it could just be that one particular index or market is leading. You need to still use traditional indicators or timing tools for just a little bit more confidence in your work, if you will. But they will certainly show you divergences in a loss in momentum the same way that an oscillator might. In times like today, where correlations among sectors and individual securities are at all-time highs, how do you use relative strength? Well, you're absolutely right. The correlations in the S&P 500 stocks, I know I saw some studies by regular, well-known technicians and stuff, and they're ridiculously high, but it still works. It's amazing, but it still works. And just notice the swings that we had coming off those recent lows. You're still going to have everything moving in one direction, so you have high correlation, but it's just what is going to outperform. So that's really the main question. Everything can be going up. 100% of them could be positively correlated, but you're still going to have some that outperform. So what is my opinion of fund managers that may be using relative strength techniques, and what look-back periods would they likely favor? Well, obviously that 6-month window is a pretty widely broadcast piece of information. I think everybody is wise onto that, and I do think that you can still outperform if you use relative strength. I think that you will do best if you are cognizant of the fact that it all is dependent on the trading environment that you're in. And you would want to be very, very careful if we started seeing more and more warning signs that we were about to enter into a potential breach of support levels, and that probably is more likely to occur, once you've had some type of distribution top in place. Obviously, it's an interesting environment right now. But I think that the other thing that would be important to note is that you will do best, I think, if you find a creative way to use something that other people are not using. So either you're going to combine it with another tool, or you're going to come up with your own little twist on things. Like I like to look at the thrust very early on, just a couple days after a major cycle low. So I think that you need to be creative in the way that you apply stuff and do your own research, and I think that it will still continue to outperform. You just need to be aware of, are you in an expanding environment or perhaps a contracting environment, in which case everything can be weak. When to place bets, what's the fine point of confirmation? Obviously, I think the closer to a swing low, or just right after a swing low is made, that's going to be your best risk reward, if you will, because you've got a well-defined risk point. And you could see that even with the little charts where I had the 5-minute swings. So think of relative strength as not necessarily being your timing indicator, but you've already done the timing with something. Now what vehicle are you going to use? So you're not using it for the timing. It's just going to be a little bit more perhaps fine-tuning your vehicle. Are you going to pick one stock over another stock? Am I going to purchase gold over silver or silver over gold? You know, do I prefer the Canadian dollar over the euro currency, or on some days the euro currency outperforms, you know, other currencies to the upside? So think about it more in those types of terms. Next question, in setting your swing points as launch points for relative strength comparisons, would you prefer to use multiple pivots or reset each time a major pivot takes place? And how many days do you expect before a pivot becomes irrelevant and needs to be replaced? Okay, that's a good question. Let's take, for example, when we're looking at stocks, relative strength with stocks, I would like to use as my benchmark an index. So I'll be looking at the swing low or high or the patterns in the underlying index. And again, timing, when I feel like I have a buy or sell on the index, which stocks, then I go down to my relative strength stock selection. Which ones, if I'm looking for a buy on a pullback, which ones actually have been the best bid on the preceding upswing. So if they just had a good upswing and they're putting in a much higher low, obviously I'm going to use that as my vehicle to buy. So you know, I'm kind of one of those people that I like real visible swing lows or swing highs. You know, I like to see it isolated by 2 or 3 bars on either side of that key swing low, because I find that the more visible a chart point is to the most market participants, the more powerful it is. Everybody sees the same thing, and that's what made that last swing low in October so ridiculously powerful. It was a very visible chart point. And these swing highs and swing lows, they're like magnets, you know. I mean, I have to say that no matter what the market is, they are just psychological magnets. So it should be fairly obvious if you're looking at a daily chart, for example, what the real visible swing highs and lows are. In looking at relative strength in trading ranges, how has it worked over the past 3 years? Or the past 3 months? Again, this goes back to coming off of a major low, but I would love to direct you to a wonderful, wonderful body of work put out there by Gary Anderson, and he actually won the Charles Dow Award. I think it was 7 or 8 years ago. Gary Anderson, all you need to do is sit there and Google Gary Anderson relative strength or something like that. I mean, Google is absolutely just such an amazing tool that we have at our disposal. And Gary really did a wonderful body of work there in putting these things into quadrants and actually making a case for when we enter certain types of trading ranges environments, there it's okay to buy the weak stuff, the underperforming stuff, as it shoots up to the upper end of the trading range. And the stuff that's already been bought up, you want to stand aside with. So I would direct you to review Gary Anderson's work. He's been an MTA member for many, many, many years. Huge Wyckoff fan, and I totally respect all his research. And I'm so glad he won the Charles Dow Award for that. Am I holding any E-mini positions overnight these days, or only day trades, given the large gaps these days? That's a good question, because I don't hold the E-minis nearly as much as I used to, and in general I find that it's better off just to start the next day with a clean slate. If I'm going to position something, I found it better to use options or stocks, or you know, sometimes I used to go buy bull spreads in call options, or put spreads, vice versa, if I wanted to take an opinion. So you have to have a reason for putting on a position based on better intermediate term work to establish a position and sit with that, as opposed to just saying, okay, you know, today I'm going to go long or short, and the next day da-da-da-da-da, because you're right, you know, it's there's just so much more noise and movement overnight, and of course all the risks with Europe and stuff. I like keeping the S&Ps or the E-minis as my day trading vehicle. And I find if I try and commingle putting on positions in them and day trading, it doesn't work. So I hope that answered your question. If there's no more questions, I hope this is archived and everybody can review these slides. If you wish to email me for any further questions in the future, my email address is lbrgroup@att.net. And I just love networking with people, especially all the fine technicians in the MTA organization. And thank you very much for having me present today.
And on behalf of the Market Technicians Association, we would like to thank Linda for presenting today. If you do have any other questions that you could not get to today, please do feel free to contact a member of the MTA staff, and we will pass your question along to Linda. For those interested, this webcast will be archived and posted in the on-demand video archives probably early next week along with the slides. I thank you all for attending tonight and hope you enjoy the remainder of your evening.